Hello friends, my name is Shilpa Jaisinghani and I am a chartered accountant by profession and into practice for more than 5 years now. The most common query that comes to me is, "Ma'am, business चालू करना है, company बना दो." To which my answer is, हर किसी को company नहीं बनानी होती. Basically, their query is which form of organization to go with. Now, by form of organization, we mean to decide a structure of business that would define your ownership, accountability, and responsibilities in the business. So, today we'll discuss different forms of organization, try to compare them, know their pros and cons, and try to conclude. Whenever you start a business, you need to take various decisions, but deciding the form of organization is definitely an important one because it is going to have long term implications. So, to decide that, you need to first assess the size and nature of your business, level of control you wish to have, source of finance in your business, tax implications under different forms, and various other factors. For this, need to know the various advantages and disadvantages of different forms so you make the right decision. Let's come to different forms of organization. Number one is sole proprietorship. Any person can form a sole proprietorship with any business name of their choice. Yes, this is the most common and easiest form of organization. The sole proprietor has 100% control, 100% rights, 100% duties, and yes, also 100% liabilities. Yes, the owner is personally liable for all financial obligations. The sole proprietorship firm has no separate legal entity. Yes, the owner and the firm are one in the eyes of law. You don't even have a separate PAN card for your firm. So that means everything that is done by firm is done by the owner. You are personally liable. Your personal assets are at stake if your firm is obligated for any debts. And there is no separate governing body to sole proprietorship. So that means you don't have many regulations to follow. Next is a partnership. When two or more people come together who agree to share profits or losses of a business in a predefined ratio, which we call as profit sharing ratio, they can form a partnership firm. You can form a partnership with minimum two people. Uh, Now, partnerships can be formed either verbally or in writing, but it is always advised to have your terms write down in which we call as partnership deed. Define your terms with all the partners, whereas you define the control who will be controlling. The control in a partnership is with one or all partners as you define in the partnership deed. The biggest drawback of partnership firm is that the partners are personally liable for financial obligations of the business. Yes, the firm is not a separate legal entity. It is depicted by the partners. Registration, although is optional for a partnership firm, but it is always preferred to get your partnership firm registered with the registrar of firms and societies of your respective state. Next is a private limited company. Now, private limited company is a legal entity on incorporation, separate legal entity, and it is a privately held business by a few people who are bringing their funds together, who are known as the owners. They get the shares of company as per their percentage of holding. The owners are separate from the managers. The business is managed by a board of directors who will be having the governance of the company, while the ownership rests with the shareholders of the company. Now, as the company is a separate legal entity, the company is liable for its own obligations. Yes, your liability is now limited only to the extent of holding or investment made by you in the company. Also, ROC, Registrar of Companies under Ministry of Company Affairs, is the governing body where you need to get your company registered, file annual audited accounts, and other filings. Next is one person company or OPC. By the name itself, we can see that it is a company run by a single person, which is again a separate legal entity on incorporation. The single shareholder is the sole owner of the business and has the entire control. Directors are the managers of business. Now, again, individual has limited liability to the extent of his investment made in the company. So we see here that the drawback of sole proprietorship is basically covered here. We get an advantage over a sole proprietorship form. Again, MCA is the governing body where you need to register and make various filings. Yes, but OPC is a bit lenient than a private limited company. Next is limited liability partnership or LLPs. It is a type of body corporate that gives advantage of private limited company and flexibility of a partnership firm incorporated under LLP Act 2008. Now, what we see here is this form gives us an advantage over the partnership firms. In partnership, we had unlimited liability to the partners, whereas in LLP, the partners have limited liability. Each partner is also not responsible for each other's action. So now they are agents of LLP and not of each other. Again, you need to have a LLP agreement with all your partners so you can define the terms between each of you. Again, registrar of LLP under MCA is the governing body where you need to register, file annual audited accounts and other filings. So LLP gives us an advantage over partnership forms. Now that we have seen all the major forms of organization, let's try to compare them. As we have seen OPCs and LLPs, as they are hybrid structures, we'll be covering here only proprietorships, partnerships, and companies. Let's start comparing them. As we see, proprietorships generally don't need much of registrations, or you can just go for local registrations and licenses like Gumasta and everything required in your respective states and start a business. For partnerships, you need to write a deed and then get it registered with your registrar, firms and societies. This is, again, I would like to tell, this is recommended because whenever there is a dispute among the partners, you can a registered deed is required. Also, if you're going for bank finances or subsidies, they would ask you for registered partnership deed. So be clear, if you are going for a partnership firm, always try to have a registered partnership deed. And as we have seen, company need to have registered with ROC. Also, for a company, you need to have prior name approval. While for proprietorship and partnership, you don't need any such name approvals. Then proprietorship can be formed with one person. Partnerships, you need minimum 2 and maximum 20. And LLP, we don't have any maximum limit. While we have seen in a private limited company, you need minimum 2 people. That too, if you're forming a OPC, you can form it with a single person. And now, control. In a proprietorship, the entire control of the business is with the proprietor himself. In a partnership, you may have working partners and non-working partners. So, as per your deed, you can give control to working partners and all. Then next is company. In a company, generally the decisions are made by passing a resolution. So when you pass a resolution, you generally get one vote per share. So the person having the maximum share gets the maximum vote. So ultimately, the person having the maximum holding in the company has the maximum control over the decisions of the company. So in a company, the control is with the shareholders as per their holding percentages. Next is liability. As we have seen in proprietorships and partnerships, the liability is unlimited. That means your personal assets are even at stake to meet out the financial obligations of the business. While in a company, your liability is limited to the extent of holding or to the extent of investment you have made in the company. Next is investment or source of finance. Now, this is a major point you need to know before you make a decision for form of organization. See, when a person generally has either his own funds to invest in a business, or you can go to banks for finances, which we call a secured loan. And the third one is unsecured loans, which we are borrowing from the persons we know or the people around us. So, in a proprietorship or partnership, you can get in funds from any person you know as unsecured loan, pay them interest on that funds too. But in a company, you have a restriction on getting unsecured loans. A company can get unsecured loans only from its directors. That too should not be borrowed funds. So, if you are before choosing any form of organization, you must be clear in your mind where will you get the amount of capital from, or where will you get the amount of funds that you will be requiring to continue your business. Next is accounts and audit. As we have seen, there's no governing body to a proprietorship or partnership firm. There's no such strict accounting or audit requirements made. But yes, if your turnover limits cross the limits of Income Tax Act, you definitely need to get a audit done under Income Tax Act. But for a company, even if your turnover is nil, you need to have an audit under Companies Act, which means if your turnover is zero, in either you need to have an audit from under Companies Act. But if your turnover is also exceeding the limits of income tax, you need to have both audit under Companies Act as well as audit under Income Tax Act. That means the cost of maintenance of a company is quite high. Next is profit distribution. Profits deriving from business of proprietorship can be withdrawn by owner. In partnerships, it is generally distributed to partners as per their PSRs. And while a company has a choice to whether to distribute or not as dividends. Next is continuity. If the owner of a proprietorship dies or retires, you need to shut down the business. While the partnerships also get dissolved on death, retirement, or bankruptcy of partners. While a company is said to have perpetual existence, by perpetual existence we mean the shareholders may or may not be there, but the company shall be there. For example, if a shareholder of a company dies, his shares are transferred to his legal hire. So only the name of shareholder is changing, but the company remains in existence. Next is governance. As we have seen, the proprietor has the 100% control and management of the company. In partnerships, as per the deed, one or more partners may be held responsible for governing the business. While in a company, you can have the owners have a separate board of directors to manage the business. Next is winding up. A proprietorship and partnership can be wound up anytime at will by a proprietor or by partners. But in company, you need to follow legal formalities and everything to wind up a company. It's not that simple. So it is not easy to wind up a company. Um, in winding up, generally businesses are closed and net assets, assets minus liabilities, what we generally understand. If there are any net assets, they are distributed to owners as per the percentage of holding. Now, apart from these basic differences, there are two things: cost of formation and income tax implications, which you need to understand. Although cost of formation and tax implications are not going to help you judge which form of organization to go with, these are not the deciding factors, although, but definitely you need to know these things before you go for any form of organization. So let's see the comparison between cost of formation in all the three forms. In proprietorship, as we have seen, it is there's no such registrations you need. So it is very cheap and almost personal. You just need to have few local registrations and open a current account, have a business name of your choice, and just start the business. Next is partnership. For partnership, yes, to write a deed, you need to pay the stamp duty and registration charges. That would cost you around 10 to 15,000. This again varies as per your state. Next is company. Company registration is comparatively costly. So now, for a company, fee depends upon your authorized capital and the state in which you are going to have your registered office. So you need to calculate that fee on MCA portal. You can go there and check it out. And apart from that registration fee, you need to pay separately for a name approval, then DIN, which is director identification number for all the directors, and digital signatures for all the directors. So a company formation might cost you around minimum rupees 20,000. This is for like a pay authorized capital of 1 lakh. So that is comparatively costly to other firms. Next is understanding the tax implications. Yes, this you need to keep in mind because this is again going to have long-term implications or like year-on-year implications on your business. For a proprietor, as we have seen, it is not a separate legal entity. You don't even have a separate PAN card for a proprietorship firm. The entire profit from business is taxable in the hands of owner, which means that he gets the benefit of slab as an individual, which is a plus plus for proprietorship. Next is partnership. Now, in a partnership, whatever profit you are getting from your business, you get a deduction of partner's salary and partner's interest on capital as allowable under Section 40B of income tax. We are not going into that. But yes, from the business arriving from profit, you get a deduction of partner's salary and interest on capital. That gives you taxable profit from business, which is taxed at the rate of 30%. And yes, other incomes are taxable at their respective rates. Now, what happens to this partner's salary and interest on capital? They are taxable to partners in their hands as an individual. So again, they get a benefit of slab on the salary and interest amount. So we can say a firm is taxable at the rate of 30%, which you can see is comparatively higher than what we have seen in case of proprietorship. Next, in company is also the entire profit is straight away taxed at the rate of 30% to a company, but subject to Section 115 BAA of Income Tax Act, your company can be taxed at the rate of 25%. There are some other factors too, which you might consider before choosing your form of organization. Number one is Startup India scheme. If you want to get the benefits of this scheme, you cannot have a proprietorship firm. You can only form a registered partnership firm or a company to avail the benefits of this scheme. And yes, as we have seen, the company is making all the filings to MCA. It is said to be, it is said to have the highest transparency as compared to proprietorship and partnership. Now let's try to conclude everything. See, these are only general conclusions. Deciding the form of organization depends on case to case and depends on number of people involved and various other factors. On the grounds which we have discussed till this is a ideal, we can say, or a general conclusion which we see around. So the simplest and easiest form of organization is sole proprietorship. If you have the funds and only you are going to manage the business, go for it. Next, if you have a family business or close relatives involved in the business, joint funds involved, see, in a partnership, you need to be very thoughtful of which people you are getting into partnership with. So it is generally when there's some sort of family business, then only you should go for a partnership, or when you have people you are closely related to, so that the chances of dispute are very low. But still, if even though if you're having a family business or very close people you are entering into partnership with, always write a deed and then proceed. If there are many people involved, or say you'd like to keep it formal, divide your shareholdings and that no person is personally liable for each other's act. Always form a company. um, Although OPCs look attractive and have been introduced for new age entrepreneurs, introduced since 2013, there are not even 50,000 OPCs registered till date. Also, LLPs were introduced via LLP Act 2008 to give partnerships an advantage and can be said to be the cross-breed corporate structure. But still, we see more private limited companies getting registered. One thing that we haven't discussed here is not forms of organization for a not-for-profit business. Not-for-profit businesses are generally those which are formed for charitable purposes or mainly not with the motive of earning profits. So they can be formed either as trust or societies or cooperative societies or Section 8 company. If you want me to make a separate video on this, do let me know in the comment section below. That's all my time, and I would like to thank Mr. Vivek Khurana and Team CA Sansaar for giving me this opportunity. And I'd like to request you all to like, share, and subscribe to CA Sansaar, and do let me know in the comment section below how do you like my video. Also, pass on this video to your friends and others you know who are going to start a business so that it can help them. Thank you so much.